Thank you.
Okay. The debt elimination software that I use is through a company called Your Family Bank. Okay. But we're not through Your Family Bank. We just use their software. We have our own system and process. Okay. I use the Family Bank software because of the beautiful reports, the debt elimination reports that I'm going to show you. I use them because I haven't found another firm that produces reports like this. So that answers a question. Why do we use YFB software? Because I like the reports, and I think you're going to too. But the software piece is not the most important part of this process. Running illustrations is not the most important part of this process. Learning the education is. Learning the right words, said in the right way, at the right time, will make all the difference in how many people you help. Okay. So I'm going to speak to you today as the prospects, as the potential clients. And just for my memory, today's prospects are Mike and Stephanie. My wife, Stephanie, we're high school sweethearts. We've known each other for 35 years this March, and we'll be married 28 years. And also what's pretty neat and not common is we're business partners as well. So we're best friends and we work together. So some people have called us unicorns. Okay. I've done the warm-up with the client. We've discussed the who, the what, the where, the why, the when, the how. We've established some commonality. I've found out how influential my prospects are in their workplace. If they are very social and they're the president of different social clubs, I might be working with a business owner and they might have multiple employees that could introduce you to all of their employees for this process. So through the warm-up, I'm doing data gathering to see where my next introduction is going to be. All righty. I've done that. And now here is the transition into the education. All right, Mike and Steph, fantastic. Are you ready to get started? Very, very good. By the way, excuse me, everybody, a little sidebar. You can see the two questions on the screen, yeah? Somebody just say yes for me.
Yes.
Thank you very much. I don't want to keep talking without the visuals. Beautiful. Okay, Mike and Steph, ready to begin? Fantastic. All righty. A reminder, today's education has nothing to do with investing your money. We're not here to talk about an investment process. We also are not here to review anything to do with consolidating your debt for a fee or refinancing debt. I'm here to share details regarding our debt payoff process. And after a little bit of background information, I'm going to show you examples of clients that have used our process. And if you like what you see, you're going to have an opportunity to have a side-by-side report prepared showing you how our debt payoff process compares to the one you're doing now. Now, Mike, you already know there's no cost or obligation to get your report, but I'm going to need information from you to do it. And the information, it's pretty common sense. I'll need to understand the money that you owe. So how much is your mortgage? Your mortgage is. What's the interest rate you're being charged on your mortgage, your credit cards, car payments, business debt, etc.? And then lastly, what payments do you make? Do you make the minimum required? Or like many people do, you'll put extra money over that minimum every month. The other bit of information my team and I need is where do you keep money? The bank, brokerage, IRA, 401, etc. My team and I will take that information, we'll analyze it, and we'll produce a report that if you're like most people we work with, this report's going to show you how to be debt-free, completely debt-free, including no mortgage, 2 to 3 times faster than you're on track for. And what's really terrific, with more benefits and money as well. Now, many of us get paid every couple weeks. Money drops right into our checking account nowadays. And if you take a look for so many people today, lots of money leaves their household in some form of interest or some form of tax. Now, when people want to save more money, I don't think we have any doubt on the piece of the pie that we've got to shrink a little bit. We got to reduce lifestyle, don't we? We got to cut up our credit cards, tighten our belts, eat beans and rice, and have no more fun. Well, it's not that that process I described can't be done. It's just not done by most of us, because for most of us, what I've described is very similar to setting a New Year's resolution. And we all know when we break those, huh? Yeah, 99% of America has already broken their resolution by this time in January. Something too hard is not easily followed. What we do and what you're going to see is we minimize the outflow of money. And by doing so, we're going to add money to the other two pieces of the pie. Now, Mike and Steph, real quick question. Do you two work with a financial advisor? Oh, that you do. That's terrific. About how long? About 13 years. Well, yeah, up until last year and then going into this year, things were going okay, weren't they? Yeah, I know. I'm a bit nervous about the future as well. Another question for both of you. Could you go put your hands on the debt payoff strategy that your advisors put in place? Well, I always ask, I didn't think you'd have one, but that's just another confirmation that your financial advisor and we do not do the same thing. You see, your financial advisor, if we dug a little deeper into the plan they've provided, your financial advisor has you on an accumulation plan, okay? An accumulation of money plan for your financial future and probably for your retirement. And if we took a look at that plan, what we're going to see is that your advisor has you systematically contributing money into some type of an account, normally over a 2-decade period of time, before you see any results of significance. By the way, if we did take a look at that report, your advisors put a rate of return that your money is going to accumulate at, didn't he or she? Yeah, they did. Do you remember if that advisor said the return was guaranteed, or did they use the word historical? They used historical, didn't they? Which I think you know is just another way of saying not guaranteed. What's my point? My point is, as we go along with this education, what I want you to kick around, both of you, is, do you prefer the financial situation you're sitting in today, or would you trade it all to be debt-free, including no mortgage? And the reason I want you to kick that around is because if my team and I would have had the opportunity to provide you service for the last 13 years, I really believe we'd be talking about you being completely debt-free over 4 years ago. Now, a little bit of funny and a little bit of seriousness here, and I'll make my point here in just a moment. I got a business proposal I'm going to offer you, but I'm going to set the terms of our new business deal. And after I show you the terms, I just want to know if you want to go into business with me. So here we go. In our new business, Mike and Stephanie, I want you to front all the money, take all the risk, and do all the work. And then in the future, when you want to enjoy the fruits of your labor, that's when I'm going to come back into your life and tell you what you owe me. Do you guys want to go into business with me? Yeah. Does it surprise you in my entire 3-decade career that nobody's ever told me yes? Now, here's the serious part of what I said. What I've described here is very similar to how your 403b, 401k, IRA, SEP, etc. works. And the reason that I'm bringing this to your attention is the next time you look at those account values, what you've got to remember is that all the money in those accounts, they aren't yours. Some of them is going to go off to the U.S. Treasury in the form of income taxes. So what I recommend people do is that the next time you look at those account balances, I recommend you carve off about 20% of that money that you're not going to be able to enjoy. And instead, you focus on 80% of that money. And what I think you'll accomplish by doing that exercise is it's going to help you reduce or possibly eliminate the opportunity of running out of money in your retirement years. Now, in any plan, there are risks to address, and you're going to see our planning addresses these. Remember this game when we were kids? Well, we're now all rolling through the game of life for real. And both of you need to congratulate yourselves for taking the time to see whether or not focusing on becoming completely debt-free places you in a better position, not only for your immediate financial future, but also for your retirement. Because unless more people begin to do what you're doing, which is focusing on debt elimination, More and more of us are going to be in debt from the time we graduate college, university, or trade school, all the way through our deaths. And I've yet to meet anybody that said that was their retirement dream. Important piece, open up your ears on this one, because everybody's got a question that I'm going to answer here. We understand that many times, or sometimes I should say, sometimes our clients, they need to put their debt payoff process on the back burner because they've got a more pressing need for money. They've got a financial emergency that they have to deal with that requires that debt payoff in the back burner. And by the way, a financial emergency in my definition is anything to do with our or our family's health or well-being. But you know, occasionally, sometimes our clients want to put their debt payoff in the back burner because of an emotional need to spend money. And if that term emotional need to spend money isn't making sense, what if I use the phrase retail therapy? We can all agree that putting our debt payoff in the back burner because of a retail need to spend money, we can all agree that's probably not the best thing to do. But please hear this. The debt payoff plan isn't our plan, it's your plan. And what I want you to hear is that we build liquidity into our process to be able to handle those both of those issues. Last topic before I start showing you examples of clients using our process. I want to make sure you understand how a bank works, at least from my perspective. So check this out. Tomorrow morning, both of you are going to go to the local bank of your choice. You're going to open up a checking account contract and a savings account contract with that bank. Now you're sitting there with the bank employee, you're completing the paperwork. And the question I ask everybody is this one. Do you ever ask that bank employee what's in it for them and the bank for you doing business with them? Yeah, me neither. I never ask the bank employee that. I always want to know what they're doing for us. And quite frankly, even with interest rates rising, many of the people I'm talking to still aren't even getting 1% on their checking and savings account balances. Okay. Here's something a lot of people aren't aware of. Did you know, as a bank depositor, were you aware that we're not an asset to the bank? We're actually on the liability side of the business ledger. And the reason is they're paying us to be there. Now, it's not very much money right now, but they are paying us to be there. It's a cost to the financial institution. Do you have any idea how they turn our relationship into assets? By loaning out our dollars, loaning out every one of our dollars multiple times to make their rates of return. And I know you're going to agree with me on this. It's not fair. It's not fair to continue to pay us so little, but charge us so much when we want to use money from them. Okay, so now let's take a look at the first type of family we help. It's a nice family here in their mid-30s. Their names are Mark and Joyce. They got 3 minor babies, and their income $7,000 a month. Now, Mike and Stephanie, I know you're almost 50, okay? And your baby isn't 3, your baby's 18. And I didn't ask you what you earn, but I've been around a little bit, and judging by your careers, I know you're bringing in more than $7,000 a month. So what's my point in showing you Mark and Joyce? Well, it's very simple. I'm going to show you not only Mark and Joyce, but a couple of other people. And the focus that I want you to have are the benefits that our debt payoff process is providing. Because if we take a look at this young family here, like a lot of young families, they're brand new in the savings department and they have more debt than assets. And like I said, Stephanie and Mike, I know these people aren't exactly like you because with only $180,000 of debt, they can't live in either one of our neighborhoods. All right. So again, my point is, I want you to focus on how our debt payoff process handles each one of these families' debt. Because if you like what you see here with the 180 and how our process handles it, wait till I show you examples of how we handle 380, 580, and $1 million+ of debt. Now, if our family could write a check today for what they owe, they'd be debt-free. But let's get real. People pay over time. And because they pay over time, they're going to send a whole bunch more interest over and above what they borrowed back to that lender. Now, 30 years from now, this couple doesn't work with my team and I. They do things their way. They keep paying the bills or debt. They keep saving money in their retirement accounts. And in the future, When they're ready to retire, they're completely debt-free. They owe nobody a dime and they've got money in their retirement plan. Or check this out. With our payoff process, look at that. That's pretty fast, isn't it? No matter what part of the country or neighborhood you live in, that's a lot of money they saved. Now that 2177, that was the dollars, those were the dollars that left their financial institution every single month to pay the mortgage, the car, and the rest of the debt. Now they're completely debt-free. They owe nobody a dime. They have 100% equity in all their assets. And let me just give you a feel for that. Imagine Mark and Joyce's home is $500,000 and they're debt-free. Do you realize that the next time somebody asks them the value of their home and they say 500,000, that's all their money? I hope you agree with me, but I think that's a reason to celebrate. Now that they're debt-free, this family can do anything they want with the 2177. They could spend it all. They could buy more stuff like a boat, four-wheelers, RVs, etc. Or in our process, they're just going to save the money. We're not against investing, but in our process, they're just setting aside the money without any investment risk. And take a look at this. Look what they've accumulated over that same period of time. Now, I know both of you can do math. We're considerably better off financially. This client is considerably better off financially with our process over theirs. So how did we do it? Well, when I started talking with you today, I mentioned about your ability to have a side-by-side report prepared, showing you how our payoff process compares to yours. Well, I'm going to review a few of our clients' side-by-side reports. And what this report is going to verify is why our clients are choosing to add another financial institution's contract to their payoff process. And what you're going to see when we review this report is by our clients adding this new contract, not only are they paying their debt off 2 to 3 times faster, but they have more benefits and money as well. So Mike and Stephanie, let's take a look at why our clients are choosing to add a permanent life insurance contract to their debt payoff. And what you're also both going to see is why this has nothing to do with life insurance in its traditional sense. Now, remember, to do the report, we needed information. We needed all the debt information and where money's staying. And Mark and Joyce gave us that, and we did our analysis. And what we found is we found $625 a month that Mark and Joyce can send off to their new financial institution. Now, first things first, $625 is not your dollar amount, Mike and Steph. I have no idea what your dollar amount is until you decide to give us data. But what I say next should put a smile on your face. Whatever dollar amount my team and I identify, both of you have to agree to. Remember, not our plan, it's your plan. And I'm going to use a little metaphor here. When you decide to get your report and you review it, if it don't feel like slipping on your favorite pair of shoes, I'll be right in line agreeing with you that this is the wrong plan. Where did we find the money? Well, in Mark and Joyce's case, we found it in 2 places. In our payoff process, our clients continue to make the minimum payment required by the lender. They don't send any extra. Mark and Joyce were overpaying all their debts by about $325 a month. They're not going to do that anymore. They're going to send it off to their life insurance contract first. Where do we find the other $300? Well, I'm pretty certain, and you might be doing this, Mike and Stephanie, I'm pretty certain you've heard of the advisability of having about 6 months of your earnings safely tucked away in case something bad economically happened to you. Well, this couple was saving $300 in their bank. And as you remember, we build liquidity into our process. So what you're going to see is how we showed Mark and Joyce to use those dollars more efficiently to become debt-free while not sacrificing liquidity for emergencies. Now, remember, total debt versus real debt. Total debt is if we could pay it off today. Real debt is the actual dollar amount because we're paying over time. The next 2 pages, Mr. and Mrs. Prospect, they got a lot of numbers on them. I'm asking for a favor And that is, don't get ahead of me explaining each part of this process, each part of the report. So I want you to follow along with me and my cursor, because if you have a tendency to get ahead of me and start looking at all the numbers, I promise you, you're going to miss me answering a question I know you're going to have. So here we go. Our report shows you your way of paying off debt, our way of paying off debt, and the interest you'll save. Our payoff process is not based on maybes. It's based on certainty. And for that reason, your report will show you.
Thank you.
If I could have you mute, please. Your report provides you with an exact time frame of when money is available to pay off debt. There's no guessing games. Now, for a little bit here, I want to do some hypothetical. And I want you to just pretend that you're Mark and Joyce. So as I'm talking to you, you can understand process and procedure of our payoff process. Okay, first things first. The first reason this has nothing to do with life insurance in its traditional sense is we're not trying to replace anybody's economic value to their family. We're not trying to replace anybody's income earnings and the benefits your families receive from it. That's not why we're here. We're here to show you the benefits of using a superior financial institution's contract over the banks to become debt-free. With a married couple, it doesn't matter what spouse we use to put this contract on. And my point is, sometimes the breadwinner of the home isn't as healthy as the spouse that stays at home. So we'll use their life to put the contract on. Heck, many times our married couples love this process so much, they love the benefits, I should say, that we'll take the money available, split it into two, and put a contract on both spouses, because it doesn't get in the way of the first purpose of what we're trying to accomplish, which is money to pay off debt faster than your process. Okay, so the insurance contract's put in place. 625 is being sent off to the new financial contract every single month. 625. As soon as money is available in this contract, our clients use a really neat provision that permanent insurance has, and I'm going to use an acronym here. Permanent insurance has the ability for you to do OPM or use OPM, other people's money. So what our clients do is they keep their money in their contract earning benefits, and they use it as a safety net or collateral for the insurance company to send us their money. And it's very easy to get. It's just an administrative form to the company. They process the request and they put the money right back in your checking account. And once the money's there, if you were Mark and Joyce, you're going to lump sum this first baby bill. And it's just a little baby bill, $360 Visa bill. So it's lump sum paid. Now, you see this $55? This $55 is the minimum payment that used to leave Mark and Joyce's house to go to somebody else's financial institution. Now that the Visa bill is out of the way, Stephanie, where do you think we want the client or want you to send this $55? Well, not to the next debt yet. It's close. The first thing we're going to do is have you send it back to your new financial institution. So what our clients do is they roll up or snowball their debt payoff by first running dollars through their life insurance contract. Right? And our clients, they're just going to follow this process. $625 off every month. As soon as money's available again in here in month 5 to pay off the next debt. Same situation, policy loan, money goes back into the checking account, lump sum pay off the next bill. Mike, what do our clients do with the $200 that used to go to the medical bills financial institution? That's right. They send it off to their insurance contract, and they'll continue that process until they're debt free. Look at this. Within a year and a half, this family has eliminated or paid off everything but their mortgage, freeing up $1,200 a month in financial obligation. Here's a scenario for you. Imagine if this family put this plan back in place back late 2018, early 2019, and then the COVID pandemic hit us in 2020. Don't you agree that this family having $1,200 less in financial obligation has either reduced or eliminated the financial anxiety in that household? putting more money in a Roth IRA, 401k, crypto, buying real estate, etc. That is all fantastic. It's all great. But none of that did what this plan did for this family, did it? I want you to remember the $1,200 because it's going to be another reason this has nothing to do with insurance in its traditional sense. Now, any questions before we continue to the next page? Very good. Remember, the next page got a lot of numbers on it too. It's busy. Please stay with me, and I believe I'll answer all of your questions. Oh, one more that I got to cover. You know, when I reviewed that setting up your checking and savings account contracts a moment ago, when I was talking to you and I asked, do you ever ask the bank employee what's in it for them in the bank when you set up your checking and savings accounts? And we all agreed we don't ask because, quite frankly, we know the bank pays the bank employee for helping us with our checking and savings accounts. Well, what's really cool here is our clients don't pay us an additional fee to set up this process. The insurance company pays us for setting up these contracts. Very similar to what the bank does with their people. Okay. A lot of numbers here. Stay with me, and I promise you, you'll have clarity. We're going to go left to right. This big column over here, both of you have seen a financial illustration before, haven't you, Mike and Stephanie? Of course you have. Remember, this is Mark and Joyce's numbers. You get your report, these will be yours. What's the middle? The middle column here is the administration of this payoff process. Taking money out of your cash value, out of your insurance contract, and then see how come the numbers lower at the end of the year? The numbers lower because the money that used to go pay the debt, the minimum payment is now going back to your contract, allowing you to use the money again. That's all this is showing. It's allowing you to use the money again. What's the far right column? The far right column is showing you your liquidity that you have available as you're paying off debt. Now, what's this column? This is awesome. Remember I talked about liquidity? What I really appreciate about our process is the way we show our clients paying off debt with this system. We're only showing our clients using 85% of the money available to pay off debt. We keep 15% in reserve for any emergency and emotional spending. I asked you to remember the $1,200. Well, this is awesome. And another reason this has nothing to do with insurance in its traditional sense. Eventually, our clients cannot put their money that used to go pay off the debt, they can't put that minimum payment back in their insurance contract because our clients' contracts get funded up to the maximum our law allows. Kind of similar to the maximum contribution of a 401k or IRA. You just got a ceiling. Well, you got a similar ceiling here. So our clients, in this case, they can't put $1,200 back in their contract. They can put $625, but this $1,200 that's coming into their life that needs a place to go, check this out. This savings balance, or what we call money outside the policy, this is just another account that we can find that will earn you a 2% rate of return. Remember, we're not talking about investing. We're talking about certainty. Okay? So those are the columns there. Let me go ahead and drill a little deeper, and I'll fill in some areas. Okay. The gold lines here, or yellow lines, are showing you when debt's being paid. Okay. So everything but the mortgage. And then the mortgage is paid off right here. 45 and 43. Owe nobody a dime. 100% equity in all the assets. Almost everybody asks me this question. Now that I'm debt free, do I have to keep this contract? And the answer is no. And if Mark and Joyce decided to cancel it, we'd give them a 5-figure check and their plan's over. So benefit number one of our process, in their case, is debt-free three times faster than their process.
It's very exciting, Julie.
Could you mute, please?
I think I went to the part where it say
Chad,
card payment security.
Chad, could you mute, please?
Oh, I finished.
So debt-free faster than yours. Next benefit. Bad things happen to good people all the time. Longevity is not guaranteed. As a matter of fact, roughly 1 out of 4 of us does not live past the age of 65. And some deaths that you might be aware of. Bob Saget and Eddie Van Halen both lived to 65. Michael Jackson and Prince, Minneapolis, lived to 55. Kobe Bryant and his daughter lived to 41 and 15. Bad things happen to good people all the time. And what I want you to see is if something bad happened here, we've got enough money to self-complete the debt payoff process. Remember, we're not here to talk about life insurance in its traditional sense, because if we were, we'd be recommending 8 to 10 times this amount of money to leave the family. That's not why I'm here. The next benefit, a little bit of funny with some seriousness. We don't always die the first time we try. As a matter of fact, many of us can be kept alive when we've had something serious happen to us. But being kept alive means many times we need care. And the care we need revolves around our ability to feed ourselves, bathe ourselves, move around, use the toilet. Maybe we have some cognitive issues. And in the medical and in the financial industry, what I just described are called activities of daily living. And losing the ability to do those for ourselves, that because we lose the ability to do it, those are the most common reasons we need long-term care. In other words, losing the ability to perform activities of daily living many times requires our family to shell out more money for care. And what's really cool about this contract is this contract provides money, roughly 1/4 of this dollar amount times 4 years of tax-free cash flow to help cover some of those costs, which, by the way, our health insurance doesn't cover. Next benefit, our clients that use this strategy and contract, this contract has over 200% better interest than the bank, contractually guaranteed with no 1099. And last but not least, our clients that generate liability through their employment really appreciate this, because our state statute makes all the money in this contract judgment proof. No special document is needed. Just the state statute we live in here protects this money. It doesn't mean you can't be litigated against and lose. I didn't say that. What I said was this money can't be used to satisfy any judgment against you. Okay. So as you can see, by our clients just choosing to add an additional financial institution's contract to their debt payoff process, look at all the additional benefits they receive using the same money they were using prior to doing this process. Do you have any questions at this time? I'd like to show you 2 more cases. Any questions? Let me show you 2 more. Okay. Here's an older family, an older couple, 61 years old. So many people in America look just like this. This 61-year-old couple, they've got good careers, they're making good money, they drive a nice enough car, they live in a good neighborhood, they might even be saving a little bit of money in their retirement accounts, but they're in debt. And I'm telling you right now, people that are 61 don't like any of this debt. They wish they had less, but all of a sudden, you know what happens to people? Life. They were 45 and all of a sudden, there they are, 61. Boom. Okay. They don't like this debt. And as a matter of fact, when we met with them, they had told us that they've had a couple of financial advisors come by, including a CFP, and none of them could show them a way to save or invest their way out of debt, because that's not how it's done. You have to focus on payoff. Right? By the way, something else this family told us, this married couple, they said, you know, a couple times a month before we go to bed, we have a conversation about this debt. And we encourage each other to stay motivated, to not be depressed, and to continue to fire off money to pay off this debt. But we've agreed at age 70, we're not working anymore. We're raising that retirement flag and we're hanging up the work shoes. Why? 2 reasons that age 70 is significant for people. Number 1, Social Security doesn't grow anymore. It's maxed out. And number 2, when you hit age 70, you quite frankly don't know how many more good years you got left. So we did the education and the analysis. We identified $700 a month for this family to run money through. And rather than being debt-free in 24 years, look at this. Look at that. Just about 70, almost 70 and a half, you're debt-free. How much better does somebody's Social Security income, along with money they supplement from their savings and investments, spend when they don't have any debt service? Spends a lot better. Last one, high income earning professional. Happens to be a doctor. Could be any high income earning professional. This doctor is making $750,000 to $1 million a year, like clockwork. Okay, predictable, easy breezy. We learn through our process that she's got about $1 million of debt. Okay, if she was making regular mortgage payments, she'd be debt-free in 23 years. However, what she tells us is she's overpaying these mortgages or sending extra money to the lender every month, an additional $5,000 a month, $60,000 a year. Make no mistake about it. She makes $750,000 to $1 million. This is easy money to send off to the lender. By the way, what she told us is that her financial advisor and her tax professional, they want her to put this $60,000 a year into a retirement account where she gets a deduction. And she looked right at me and said, Mike, they aren't listening to me. I want to get rid of this debt. I'm not interested in deferring an obligation to the future. I want my debt gone as soon as possible. And that's why she's sending the extra money to the lender. Well, we ran a different calculation for her. Important words. We know that if she continues with her pay the lender directly strategy, she will be debt-free in 8.7 years from now. Our process has her debt-free 2 months later. So why did she choose to work with us? Here's why. Because with her pay the lender directly process, she didn't have $2.4 million of self-completion money. With her pay the lender directly process, she did not have roughly $250,000 a year times 4 years of tax-free cash flow to help cover care cost. With her pay the lender directly, she didn't have this contract that pays better interest than the bank with no 1099. With her pay the lender directly, she gave up liquidity. Because I hope you all know that if this client has made extra payments for 4 years, I hope all of you know that she cannot call the lender and say, I've been a fantastic borrower. Not only have I been on time with the payments, I've been sending you extra money. And the problem I'm having is I got into a little cash crunch. I'm a little bad off financially right now, and I'm calling to get 3 of the 4 years of extras back. It don't work like that. She has to qualify. And if she's in a bad way financially, we both know she can't qualify. Last but not least, remember, what do all business people enjoy about this contract, especially if their work generates liability? They all appreciate the asset protection this contract affords. Look at this, by the way. What if she don't want to do this anymore? Well, she's debt-free at relatively the same period of time, except when she cancels our contract, we'll give her a 6-figure check and she's done. Or look at this. Or she can put all the money back in this contract, and we just did this hypothetically for her. We don't have her putting any more dollars in this contract after age 55. So look at this. She's now got a war chest of money of almost $1 million that she can do anything she wants, including self-funding her new medical equipment, new purchase of real estate, automobiles, etc. She also has $2.5 million of self-completion money, which will help her and her husband spend their retirement dollars much more freely, knowing that she has money to come in at her death to replace it. She also has money here to cover the most common form of long-term care costs. She has money here to address sequence of return risk. And she also has money to give herself permission to do a reverse mortgage to generate even more tax-free cash flow in retirement, knowing that when she dies, the family has a choice to be mortgage-free or to continue with that tax-free cash flow. Agents on the call, that last part was for you, okay? I want you to notice, before I open up for questions here, that I didn't muddy the waters with any type of retirement income or planning talk until the last one. And my purpose was, you don't need to share every single benefit of our planning process with your client. Why? Because 9 times out of 10, you will create analysis paralysis and they will do nothing, because some people at this point already think this situation is too good to be true. And when you don't have a question from your prospect, you've got to say, you know, Mike and Stephanie, about half the time when I'm giving this education to people and they don't have a question, about half the time, you've got a little feeling in the back of your head that goes, Maloney, everything looks and sounds great, but I'm feeling like this is too good to be true. You feel that way at all? Well, thank you for sharing that with me. A lot of people feel that way. And let me just tell you a couple reasons why this isn't too good to be true. Number one, you got to qualify for this contract health-wise. And then secondly, remember, every one of my clients here had to follow the process, and it all started by them sending money off to the new financial institution. So it's simply not too good to be true. This process works if you just follow the steps. Okay. Now I'm ready for questions. Anything, anyone, let it happen. And if I don't get some, I'll start popping some on you. Oh, one more thing before your questions. This should put a smile on your face. The majority of the objections in this process come from agents and financial advisors and not clients. However, you need to ask me all of the questions you are concerned that your client might ask. I'm going to use another metaphor, because in order for you to be good at this, we got to get that boogeyman out from under the bed. Remember, the boogeyman's not real except in our imagination. So we have got to make sure together that you have all of your questions answered, so that there's no doubt that when you're giving this education, or if we're working as a team for your client, that you believe it's the right thing for them to do. That's where it starts, your belief. Okay, now I'm ready for questions. Albert.
I got a question. So, can you hear me?
I can hear you perfect.
All right. So, as I'm looking at this, my first question is, how is there an age time frame for this? And as an insurance agent, I believe maybe someone that maybe has not planned by their late 50s, 60s, they're way behind the power curve, and we're talking about final expense. And that's nothing you can leave behind. But they may have debt and things they can clear up where they can actually generate the cash. So what is the age time frame to get into this, and maybe a minimum that they should be able, or is there a minimum that they need to put into this type of plan?
So the question is, who are our prospects?
Yeah.
Okay. It could be anybody with debt, but let me tell you who I think you're going to like. Okay. You're going to like men and women. You're going to like married couples between the ages of 30 and 60 with a mortgage and at least one other debt. The magic in our process is the more debt they have, the better it is for them. Why? Because you're using the roll-up money. Is everybody with me on the phrase, the roll-up money? That's the minimum payment that used to go pay the debt. Once the debt's paid, the minimum payment is used in their financial life. And the more debt they pay off, the more cash flow they free up to use not only for debt elimination, but also their retirement future. So you're going to like working with people between 30 and 60, $80,000 of household income and above. They need to be making their debt payments. They cannot be behind. We're not rescuing anybody. Okay. Some people you meet might need to go to a consolidator or bankrupt, not our prospect. 30 to 60, 80,000 north, mortgage, car payment, and another debt. By the way, I have some young fellas, and they happen to be in Louisiana. They're in their late 20s, and they've been talking to their peers who might only have a debt or two, but they're also talking about debt prevention versus debt elimination. Okay. So This process can work for younger people, but I don't suggest that's where you focus. And one of the major reasons working with younger people's hard is because this is their first bad economic experiences as an adult. Matter of fact, people 35 and younger have never lived in a bad economy until last year. Everything they used to invest in went up. Now they're getting a day of reckoning and understanding that everything doesn't always go up. Okay. So what I just said is their eyes and ears are starting to open up to becoming debt free. All right. So C. Harding, 60 to 80. I like them married. We can work with divorced widower or widower when they have children, because remember, we are distributing an insurance contract. And I believe it's a lot easier when our clients have somebody else they care about in addition to themselves in implementing this plan. Let me keep going on that. Don't separate business debt from personal debt. And the major reason for that is your business owner clients, almost all of them have signed for their debt personally. I don't care how they compartmentalize them in their mind. They signed for their debt personally, even the business debt. So when we have a business owner client, if they happen to tell us, I only want you to focus on the business debt, we can run multiple reports. We can put personal debt on a report, business debt on a report, and I promise you, the client's going to ask us, how's it look together? So we do it. You with me? I'm pretty sure I answered your question. What else could I cover? Go ahead and just unmute when you got it. I've got I'm not sure who's asking the question here. Albert did. How about Rama? Rama or
Yeah.
Rama?
Yeah, Rama.
Rama, hi.
Yeah, good. I mean, I'm very happy that your presentation within 7.8 years, we can make the people debt free. If you don't mind, can you explain how this loan payoff, I mean, whatever you wrote there, can you explain to me? You see, loan payoff and reserve and liquid information. I understood initial insurance information.
You talking right here?
Yeah, you are right.
Okay. I believe this is going to answer your question. So we've taken a policy loan.
Yeah, that I got it.
You can see how the numbers lower at the end of the year, right?
You see, 47,822, I took the loan.
We took out the loan and the client's paying it back. See it?
This 35,834 is what?
That is the remaining loan balance at the end of that year. It is going down in value because the minimum payment that used to go to a debt this client has is now being redirected, and that money is being put back in their insurance contract to use again. Let me say that in another way. If this client didn't have our insurance contract in place and they paid off a debt, can we all agree that that minimum payment that used to leave their checking account to go pay the debt, can we all agree that money is still coming into that account from earnings? Can we agree on that? Yes.
Yeah.
So rather than having the money stay in the bank, we just want them to send it to the insurance company so they can use the money again. Using the money again means we paid the policy loan off to free the money up to be used again.
Okay.
Now you got your clarity. I heard your light bulb go off.
And the next column, E and ECV.
That's the emergency and the emotional spending. We leave 15% of the cash value untouched. We keep it liquid. This proposal is only showing the client using 85% of the cash value available, 15% in reserve. That should be awesome to everybody because we've built in a fail-safe, ladies and gentlemen. We've built a fail-safe in, haven't we? Okay?
Yeah. Mike, from your presentation, what I am understanding is you are paying annual premium, and again, from the annual premium you paid, you are taking loan cash value, and from that loan you are clearing your debt so that you are becoming debt free in 7.8 years. Am I right in understanding?
Perfect.
Okay. Thank you. Thank you.
Yes, sir.
Thank
Who
you.
else has got a question? Give me something hard. Unmute yourself.
Mike, this is Johnny. I got one.
Johnny.
All right. Let's say that I've got a client and I'm not real good at this, okay? And so I need some help. Where do I go?
Well, you're going to get me involved, and I'm going to help you with the client education, and I'll help you design the cases until you feel good enough to do it yourself, or maybe you never do. So what I just said was, how do you want to use me, and how do you want to benefit from me?
Can I get you on the case with me?
100%, sir.
All right. And then we'll split the comp.
Yes, sir.
All right. Hey, guys, that's pretty neat.
Hey, Mike, it's Cedric again. I think, and I saw Albert with his hand up. I guess when this is new for me, right? And I came in with the concept of just the title was infinite banking, right? So
I wouldn't use that. I would not use that, Cedric.
I got you. And like I said, I came in with that concept.
Oh, I heard you, sir. I heard you.
Right. So this is a lot of information to take in. So if I'm going to work this with a client, I am fighting mentally right now. That block that you talked about was, okay, am I going to talk to the client about life insurance and trying to build a retirement, or am I just taking it away and saying, hey, let's talk about a debt plan that's going to have a death benefit? Is that what we're saying right here with this? To help
Let me ask you a question. Let me ask you a question, Cedric. People that interview our firm that have debt, mortgage, credit card, student loans, etc., they really value taking a look at our education on our debt elimination process. And what's neat about our debt elimination process is the clients using it, they're completely debt-free 2 to 3 times faster than they're on track for. And they have more benefits and money as well. Would you like to take a look at the education?
Me, myself? Yeah.
That's what I would say to the client, Cedric.
Mhm.
Okay, I was role-playing with you.
Okay. Hey, you had me for a second. You got me.
And I know I did on purpose. So if I'm getting your attention, what do you think we do with prospects?
So just about the same.
With no ego, my words work most of the time. And if you believe in our process and mimic the words, you're going to get the same benefit, which is initially getting people, qualified prospects, in front of both of us to give them the education. Okay. I want everybody to hear this. I'm happy to split cases with you, but it is not my objective. My objective is to get you strong and to teach you how to do this education. So eventually you feel really good about just having me as your back office support in this process and not have to be frontline. But make no mistake, I have some relationships because my agents and advisors are busy doing something else in their business. They bring me in to quarterback this whole process because they don't have the time to do it all the time. So I want to make sure everybody hears our relationship can be designed the way that it works the best for you. Okay.
All right, Mike, once again, what's the best prospect?
I like married couples, household income, 80,000 and above, and they have debt, a mortgage, a car payment. They're saving money. Those are great people. 80,000 married couples.
But they're paying on time.
Yes, sir. Did you say they're paying on time?
Yes.
Yes, they are. They're not behind. That's correct.
All right.
Those are the best. May
But
I?
are there any benefits that comes along with this? With this process, like, because you talk about ADLs, right? So are there like living benefits? Because it's a bit of it's still insurance too.
24% of the death benefit, of the permanent death benefit, 24% a year times 4 years can be used income tax free if the client loses 2 of the 6 ADLs. I'm going to make
I
this.
want to compliment you, okay? We've got 23 people still on the call. You have done a great job.
Thank you,
Really,
sir.
really a great job.
And you only heard me speak for 45 minutes. Wait to those of you that are interested when we start training.
All right, guys. You know, Mike.
Johnny, can I add something, Johnny? Can I add
Sure.
something?
Sure.
Okay. I'm a 32-year veteran in our industry. I started when I was 19 years old. I'm 51 right now. Back in 2017, I retired as a general securities principal and registered investment advisor. That means I no longer have a 24, 7, or 65. But that doesn't mean I forgot what to say or what's going on out there in the industry. And I want to bring up something cool. Did all of you hear me get rid of the financial advisor at the beginning of the presentation?
I did.
Huh, guys? The power of what I said. Let me close. I got a lot of closings, but I'll stop talking after this. The power that I said is we're not here to talk about investing, consolidating, or refinancing. That's where all the objections are. And even though I told them they told the prospect, we're not here for investing. Occasionally, even when I said that, they want us to show their financial advisor our report. So let me role play with that for 90 seconds. Client says, you know, this really looks good, but I want to show my CPA or I want to show my financial advisor. Okay. Watch my reaction. I go, that's fantastic. That's fantastic. I got a question for you. What are you expecting them to say?
They're going to scare you.
What are you expecting them to say? I mean, we've got to agree that if their forte was debt elimination, there's no way they would have let you go 15 years into a relationship without sharing that that's what they did, right? Okay, fine. You just want their opinion. I've got something I want to run by you. If for some reason they don't like what I'm showing you, would you please ask them to put their plan in writing so we can look at it side by side based on our debt payoff process? And that way you aren't listening to words, you're verifying it in writing, like my report, that their process is better. Could we agree we want that from them? Okay. And when we get on a call with a financial advisor and we do a nice little nicey warm up, and if I'm on the call as part of your team initially, let's say Charlie Adams is the advisor. Okay. Charlie's ready for a fight. He's ready to talk about rate of return and investing and insurance is bad and blah, blah, blah. And after I get to know Charlie just for a second, I go, Charlie, I'm a retired general securities principal and registered investment advisor. And today our clients want your opinion on their debt payoff process. This is not an investment solution. This is a debt elimination process. I just took his or her legs from out of them, didn't I? They can't battle with me about rate of return because I specifically said we were not there to talk about investing. All right, let me close. I promise you, any of the objections or the stalls or anything you can imagine that your prospective client's going to say, if you're going to move forward and we're going to train, I promise you I'll answer all of them in a very professional and productive manner that moves our process forward with the prospect or gets a decision from the prospect that they hate this process and we can just go find somebody else that doesn't. But I will tell you something, Johnny, and everybody on the call. You've seen the articles. 1/3 of Americans earning $250,000 and more are living paycheck to paycheck. 1/3 of Americans earning $250,000. I didn't make that up. If 1/3 of Americans making $250,000 and living paycheck to paycheck, what does that tell you about households that are making less money? It tells you that they want to hear about your debt pay off process. They're dying for the help. All right, now I'm quiet.
Hey, guys, he's on your team. Use him. He asked you, just give him a call. My goodness, this guy is great. I think thank you very much, Mike.
Thank you
Wonderful job.
thank you, Case and Johnny, for having me here today. And thank all of you that have attended. I appreciate it.
Thank you.
All right.
Oh, Mike.
Wonderful.
This is Albert. The
Thanks, Tom.
concept, wonderful. Which company that you recommend us to use for this concept?
We're using Mutual Trust and Lafayette Life.
Of mutual.
Can you share your contact in the chart? Everyone is asking.
Okay. Where do I go here? Here we are.
All right, Mike's still open, so ask him questions.
I'm open for if you have to go, thank you for your time. I'll stay on the call till everybody's satisfied.
Mike,
Hey,
I
Mike,
think
this is Charlie.
working
sorry.
together, Mike. Oh, go ahead. Whoever 0281 is.
I'm listening.
That's okay. Go ahead. Go ahead. I'll wait.
I guess, Mike, I want to ask, like, how do we work together, like, on, as far as like, I don't want to ask what's the compensation, but like, how does the split work with that? Like, what does that look like?
Well, I'll tell you what we're working on right now. Case I and Johnny, we're finalizing that relationship as we speak. So it could be as much as half the case. It just depends on the amount of work. There's MDRT splits. Okay. There's an introduction to the client and then you don't do anything. And then there's an introduction to the client and you're doing more service and follow up. Here's the short of it, Cedric. Where this planning process all starts is you got to learn what to do first. Okay. You got to learn the words and you've got to feel comfortable with the entire process. Okay. And here's what I want to say. If through our training, you're feeling really good and you don't need me on the call. I mean, some people, they take my training and they feel good enough to go deliver it with a prospect. Well, if you do, me training you is not a split. I'm on the case. I'm talking to people. That's a split case. And I want to make sure everybody knows that. Me helping you design, me helping you formulate a game plan to go talk to your prospect, that's not a split case. That's my job. You with me there?
Yep.
Okay.
Hello, Mike.
Hey,
This is
Mike, this is Charlie.
Hi, Greg.
if you don't mind, can you also provide, I think you did a little while ago, provide your contact information, please?
Yeah, take a look. Yeah, take a look in the chat box, 480-797-7843. M. Maloney at TWS Financial. My Arizona friend out here, the 480 number, 209. I don't know your name, but you had a question, sir.
Yeah, no, I think, yeah, thanks for presenting, Mike. I appreciate it. And also shout out to Cedric for asking the question that everybody wanted to know there at the end. Thank you.
Yeah. Believe me, you're gonna make money. And by the way, we didn't cover this. You talked about people to see. When you start dealing with households where the couple's 40 and older, almost always there's at least one old 401k that when you become the trusted advisor, all you need to say is, hey, Cedric, you were talking to me about having that 401k with the former employer. When's the last time you did a cash flow analysis on an account to take a look what it's going to do for you when you want to start using that money in retirement? You've never done that before, Cedric? You want me to get that done for you? Hello, hello. There's more business for you, even IULs through this process. This is a whole life debt elimination. You need to use whole life because of its certainty. Okay. I'm pro IUL, but please don't tell me that it has the certainty of whole life, because it doesn't. It does not have the certainty of the cash value. You need the certainty of the cash value for debt elimination. IUL, terrific product. You need a decade plus of it working to get that compound working. And everybody knows I'm right. I'm not against it. It's just not a debt elimination tool. It's a long-term retirement tool. Okay, but you will distribute more IUL because of debt elimination. It's not a maybe. And also, those of you that have your 65, you will pick up more of that AUM through this process. So both good questions. Who else has something? Oh, I got something to add real quick. Those of you that have your Medicare clients, they are not debt elimination, but they are all ready to hear this. Tammy, don't unmute, but I think it was you that's in the Medicare business. Every one of your clients that's getting Medicare, let's say they've got a bulletproof estate plan. They've got every document in place. Here's the question I asked them, Tammy. And again, I'm going to talk to Mike and Stephanie. And I've got a relationship with them when I ask them this question. I go, Steph, when the bad stuff happens to Mike and he can't handle his affairs, he's incapacitated. I know you have all your documents in place, but what's the first step you take in order to take over and handle everything on your own? Do you know what to do? How about you, Mike? Mike, you know what to do if something bad happens to Steffi? How about your kids? Do your kids have any idea the first step they need to take so that they can handle your business? And everybody on this call, do you know the prospect's going to say, we have no clue what to do first? So how about we get the whole family together? Check this out, guys. And we'll do successor education so that everybody who's involved with the handling and the settlement of your estate knows what to do when the sad time comes. You've all gotten a chance to know me a little bit. You know I'm pretty likable. I sound like I know what I'm doing, and I promise you I do. But what if we're in front of mom and dad and the kids? We now have new prospects to talk to, don't we? Mom and dad, they probably haven't handled their long-term care issue yet, have they? And what a great time to talk to them about long-term care costs when the kids are in the same room. And let me tell you how I do it. I go through this successor ed, which is another call. After I go through it, I look at Stephanie and I go, Steph, remember that something bad situation I shared with you? Well, now that something bad has happened, you're in full control of Mike's situation, but Mike needs care. So here's my question. Stephanie, how long are you going to be able to feed, dress, bathe Mike, and wipe his bottom? How long are you going to be able to do that? How about you, Mike? Happens to Steffi. How long are you going to be able to feed, dress, bathe her, and wipe her bottom? Yeah, I know. I don't really want to do it either. How about you kids? Who's on deck? Who's first in line when mom and dad can't do it for each other? Nobody wants to do it, do we? So what are we talking about here now? We're talking about if you need care, it's going to cost good money to get it. And what I want you to do, Mike and Steph, is I want you to start thinking about what account you want to use first to pay for the care cost. And then I need you to circle back with Peter, because Peter has some solutions that he can show you that if you need that money for long-term care, he's going to show you how to leverage it and make that account worth more money to pay for long-term care cost. And what he's also got is an answer to everybody's concern. And the answer that he has is for your question. What if I don't need long-term care? What if I just pass? Well, you're going to appreciate that every one of Peter's recommendations, if you don't use the money for long-term care, all the money plus interest is either going to go to your spouse or a loved one. So get on his calendar so he can show it that to you, okay? With the young family there, okay? The young people, they need guaranteed retirement income. They need debt elimination. They need retirement planning, tax minimization. Are you all with me? And lastly on that, you've heard about the greatest wealth transfer in the history of our nation, right? Well, when I was a boy, I was working with the World War IIers, passing the greatest amount of wealth ever created from the greatest generation to the boomers. And now it's happening again. Have you all seen the statistics that you have a 97% chance of losing the money your clients have when they die because you don't have a relationship with the beneficiaries? I hope all of you heard me, that I just gave you a process to get that relationship right now. Success only becomes before work in the dictionary, and I'm ready to work with any of you that's enthusiastic about adding this process to your practice.
Thanks,
Now
Mike.
I got nothing else. Any more questions?
Mike, thank you very much. Hey, guys, I'm going to give you one last chance to ask a question. Okay, go.
Mike, shoot, I'm gonna
Hey,
jump
Johnny,
in there.
oh,
Last question for me. Right now, I'm supposed to be in Florida learning about the flex method, right? But now I'm glad I'm here for this. Thanks, Calvin, for inviting me. Have you heard about the flex method? If so, the difference between this and that.
You know what? The flex method is a selling term. I need to know what they mean behind the flex method. And we don't need to do, the short answer is no. But if you told me how the process works, I will know exactly what it is, and I'll be able to explain the differences between the two.
Yeah, you guys talk individually, okay?
Yep, I agree with you, Johnny. I agree with you.
All right, any other questions, guys? Thank you.
hey, Johnny, this is Charlie. Just a quick.
Oh, I'm sorry. Go ahead.
Just a quick question for Mike. Mike, I know for training purposes, this session is a little longer, and we're covering things in a more granular kind of a perspective. But when we're dealing with business owners or some high income earners, a lot of times in my experience is they want to kind of get right to the heart of the matter quickly. There are a number of layers to peel back on this onion, it seems like. Do you have a shortened version or a shortened approach that you've seen that works well with high net worth folks or business owners that kind of want to?
Yeah, let me assure you something. And we don't know each other, but just let me talk. Those are some business owners. Okay. Most business owners, when I get to talk to them for 5 minutes, they all go, this guy knows what he's doing and he's worth hearing. Okay. If somebody only gives us 15 minutes, I would politely tell them, listen, we're just going to disappoint each other because it's not enough time for us to show you the details. If you don't have 30 to 45 minutes, let's not worry about getting together until you do. If I talk too fast, Charlie, the faster I talk, the more salesman I sound. I'd rather let the prospective client know if they want to understand our process, they need to give us the time necessary to give them the education. And in 45 minutes, if we haven't made impact, we don't need to talk about what we're talking about anymore. So to answer your question, is 30 to 40 minutes we can do an effective presentation, because I don't go into all the background and ad-libbing I've done for you as agents.
All right,
Perfect.
good.
Thank you, Mike.
You're welcome.
Thank you very much. Any other questions? One more last time, okay? All right, Mike, thank you.
I have a question. Hey, Mike, so I heard about Family Bank before. Who's covering the cost of using their software?
You are.
Okay, and how much is that?
It's $189 a month, and you need to go to their boot camp, which costs $1,000.
Hey,
I'll
guys,
say, go ahead,
Hey,
Johnny. You go first. Go, Johnny.
it's if you're going to be successful in this business, you need to invest just a little bit of money, okay? And that's not too much, not at all, for what Mike is. And you got Mike to back you up, okay?
Johnny,
right,
let me add on that, Johnny.
Okay,
You're going to get training first from me if you want it, to make sure, and I say this with the utmost respect, make sure you want to do this, and more importantly, if you want to, are you willing to learn the method to be effective? Because if you're not willing to do that, Ty, is it Ty?
Yes.
There's no reason for you to buy the equipment. If you don't like the process, there's no reason for you to buy the equipment. It's okay. But if you like the process, as Johnny said, no different than if you were a plumber. You need your own set of tools and you need a truck.
all right. I think I said a Rolls Royce, but,
Yes, like just Cedric, I saw your question. All
all
right.
right.
For those of you that have more questions, you got my contact. Johnny, why don't you go ahead and close us out?
Okay, guys. Mike, thank you very much.
Thank you very much, everybody.
Marvelous presentation. And I think we have the best look at debt elimination. And I won't use the word bank, Mike, because, but anyway, Mike, wonderful job. Thank you very much, guys. And call Mike. Mike, give us, sir, you know, are you going to give your contact information now? How's that work?
It's in the box, 480-797-7843. Maloney at twsfinancial.com.
All right, you guys got a case you want to work on with Mike, and that's the best way to start because you can't learn anything unless you got a client. Do you agree with that, Mike?
Absolutely, sir.
Okay, let's go. Thank you very much.
Thank you very much.
Thank you, Mike.
Thank you all. Bye-bye.